This question is asking us to calculate residual income for the division of a company. Now, as we set this up, first of all, residual income is simply how much profit we are earning, how much operating income above a certain minimum level of return. So this company has a minimum required return of 13%. That is basically them setting the benchmark, saying that in order for an investment or for a project to be acceptable, it needs to give us at least a 13% rate of return. So what we're going to do is we're going to take this 950,000 of operating assets, and let's simply multiply that by the minimum required rate of return. So what this is telling you is for an investment of $950,000, this company expects to receive a return of at least $123,500. Now, the residual income is any profit that is above that minimum rate of return. You can almost think about it as like a hurdle. You get above that hurdle, and everything else is excess or residual. So the residual income in this situation is $11,700. Now, situations where you would want to use residual income, it's possible that a company could have an investment opportunity that would exceed this residual, or this required rate of return, but might cause return on investment to decline, especially if return on investment was north or greater than 13%. So if you had a manager or decision maker that was evaluated solely on return on investment, that person might be unwilling to make an investment that would make ROI go down, even if that investment was good for the company as a whole. That's where the residual income can come into play, where you would basically say, hey, you know what? As long as that investment gives us a return above 13%, we're going to deem that to be a good investment. And it would motivate managers potentially to do things that are not only in the best interest of the company, but also in the best interest of the manager themselves.